we're back to another segment of our training. I'm going to look at the basic fundamental accounting now. Write it down before we get to this. Basic fundamental accounting. Now, when we talk about basic, we're talking about the foundation, the grassroots principle that we must apply when we are using terms in accounting. And I said that here, you may not be qualified accountant, but you can fit in accounting work. Number one, accounting. Now, when we talk about accounting, what is accounting? Accounting is procedures of collecting data, recording, summarizing, analyzing, and then report it on this data. Accounting is a procedure of collecting data, recording, summarizing, analyzing, and then reporting the data related to financial transaction of an organization. Number one, you must collect data. Number two, you must record data. Number three, you must summarize data. Number four, you must analyze data. And number five, you must report. One, collecting. Two, recording. Three, summarizing. Four, analyzing. And then five, reporting. Reporting the data related to the financial. Now, if you look at all that we have been discussing since we came, as to center on what we just put down now.
So is it true? So I'll tell you the definition again.
Is it true? All that we have been discussing center on these things and that for accounting. When we talk about accounting, we are talking about you collecting data. What are the data you are collecting? The data offering that you are getting from the districts. Those are raw data. Now, apart from that, when we look at the sources of funds, you are getting information from the districts. And from these pillars, you get what we call the collection of data. And what data are we collecting? We are not statisticians. All that we do is to collect financial data. You understand? What are they? The type of offering you see weekly, the other monies that comes in, the save money, retreat money, the stipulated stability money, and others' money. These are the data you are collecting. Now, when you collect this data, what do? You record it. And if you are accountant, you are collecting and you are not recording, that is not accounting. There are some people that collect the money from these districts, but they cannot trace any records of this money they are collecting. They keep collecting. And I'm citing examples since we started. How some people collect money for retreats, how they collect money for crusades, how they collect money for congresses, and so forth. But then, you can't trace the record of what they are collecting. Where are they collecting the money for? And that cannot be accounted. Now, apart from collecting, reporting, the next one for you to summarize. You have to summarize this recording information into a respective sub-aims. You cannot mix up everything together and say you are recording. And that's why that the analysis you have to show you In that 42 column analysis books, we have column for tithe and offering, we have column for retreat, we have column for building project, we have column for other collections. But these days, somebody just pick one book, and all the money that comes in, you just bundle up everything together. There is no summary. Summary should be distinguished between different sources of funds. Is that okay? Now, after you have collected this and summarized number 1, collect, 2, record, number 3, summarize, and number 4, you analyze. That analysis is what I'm talking about now. This one is that offering. This one is retreat. This one is crusade. This one is for conference. This one is for building. You understand? So that when people are contributing money for the building, you don't bring it to make a part of the offering. In our regions, because of the ongoing building construction, brethren make some vows and pledges. Am I right? And when they pay this money, even in your bank statement, unless you are not able to identify it, then you cannot put in other offerings. But the moment that they are aware that this money was paid specifically for building work, you should do what? Analyze your money and bring it under what? Under building column analysis. Now, after you analyze this, the next thing is that you report. You report these. All the things, the processes, and your person may not have time to go through to the grassroots of how the money was generated. You understand? All that you want to see is what is a report. And in that report, as an accountant, you should have a template, either in Excel or in a paper book, that you summarize your weekly or monthly type of offering and other incomes. And not only that, you only analyze your expenses, and that is what we call what? Income and what? Expenditure. That's the simple paper that the executive want to look at. He doesn't have time to go to the grassroots. But like what he said now, that means that your pastor is carried along from the one. I'm sure that he's the one that controls the alert. You don't know. Now he has, you know, it is when you work in small organization, one man can have the oversight function. But when the organization is large, like here, my pastor don't know anything that is going on here. How many alerts will he keep in his phone? He doesn't have time. I have a dedicated phone for alerts. I don't move it about. And that is in the office. Because even dicey for you to carry alert that contain the church alert. So I take that one. And that one too cannot be diverted to his phone. How many? We didn't have time. We didn't have so much to do. We didn't have time to be looking at alert one by one. That's why I said, even in the internet banking, he doesn't have time. The issue that should be able to know what to have. And then what to have is what you are reporting. So this is what came in. So they can use for decision making. Because the essence of reporting is for decision making. If your pastor doesn't have this information, you are left him in air, is confused. And once he's left on air without having this information, they can't take decision. It is based on this information and the report they are giving to you that can now decide, sorry, this is what I think we have this week and we can pay this and that. Although the request will keep coming, you cannot pay all because of what you want to have. But in some of our region, they know what they have in the bank and they decide. So you must drive along with them. So as I said that accounting is important. So let me just round up that. Accounting is a procedure of collecting data, recording the data, summarizing the data, analyzing the data, and then report the data of the financial transaction of the organization. Now, why accounting is very important? Number one, accounting helps in decision making. In fact, it's a core. When you have correct accounting, you allow your chief financial officer to take decision very smoothly and freely. Now, apart from that decision, your financial reporting will help decide whether they are going up or they are coming down. Are they making progress or they are progressing? And that's sometimes we have comparative report analysis. You bring last year reports and bring this year report and look at, as at January last year, what was our tithe offering and what was our tithe offering this January? Is there any variance? Is it favorable or unfavorable? And if favorable, then what do we do that we now have favorable situation? Or if we are not, it's negative, you now find out what's the reason. That's analysis decision. So it helps in decision making. Now, there are some principles at the foundation of this accounting we need to observe. Accounting professional globally uses a set of standards. A set of standards we call CAP. Write that down. CAP. GAAP. GAAP. That's what is used globally as a standard setup for any accounting situation. What does that mean? Number one, G. In generally, write that word here. GAAP. G means generally. A means accepting. The other A means accounting. The other P means what? Principle. That is the global. That is the global standards uses in accounting. Now, what are these fundamental accounting principles? We'll look at a few of them. Number one, revenue recognition. 2, historical costs. 1, revenue recognition. 2, historical costs. Cost. C-O-S-T. Cost. Number 3, matching principles. Matching. 4, full disclosure. 5, entity concepts. 6, expenses recognitions. 7, objectivity. Number 1, when you look at revenue recognition, now, at what point do we recognize revenue? Yes, who can answer that question? Now, looking at the method of accounting we are using in the church, and I told you there are 2 major accounting methods, which is cash basis and accrual basis. In the church, we use accrual. Now, using accrual method, at what point do we recognize revenue? Yes.
sometimes at the end of the month, the payment will be, it will enter into another month before the land pays.
Now, let me tell you at the point that it can be recognized. For example, by the time we were collecting data to send to Lagos that time, we were having South meeting. You are not seeing the money, but somebody in that location said, okay, this was how much came in. The money I come to you. But someone just give that information. Sorry, sir, I would have come here, but this how much you will see that month, will bring it. The money is not here, but they are giving you information. What will you do? Acknowledge it. That's what we mean by what? Revenue recognition. But mostly in the business world, once goods are moved out on credit, of course, in the recent time, business have mostly dealt on what? On credit. Once that move, the goods are left your premises to your customer clients, you already what? You already dispose it. All that you are waiting for is what? The actual inflow. So do what? Recognize it once the goods leaves. Is that okay?
Yes.
What if there's any requirement?
Now, because we have what we call the original books or prime books of original entries. We have about 5 of them. We have what we call sales day book. We have purchase day book. We have return outwards day book. Return inwards day book. We have cash. We have petty cash. And then we have ledgers. Now, peradventure, in the business world, they have sent out some goods, and the arrival of the goods to the premises of your clients, they discover that some of those goods are substandard or on transit. Some of them damaged on transit. They will not take it. They have to do what? They have to reverse it back to you. And when they send it back to you with credit note, what do? You now open your returns inward record. That return inward record has to do with your sales and return you received. I think you need to come to my class at NTC. You want to get certificate. So what I'm saying is that once these goods are returned, obviously you're expecting 500,000 naira. Are you with me?
Yes, sir.
You're expecting 500,000 naira because of goods have moved to your clients. Somebody discussing when I'm talking about.
Okay.
That man there. Now, your goods are moved and you're expecting 500,000 naira. But when the book goes to the premises of your clients, they are uploading the goods. And eventually, either they now discover that some of these goods are substandard, they will not return it with them. Or in the other way around, the goods are damaged on transit. You understand? Now the person will now send back to you the goods that are damaged with a letter, credit note, that please, when these goods arrive at premises, I discover that these one were either damaged or were not what I wanted you to do. So I return it back. What would that one do to your sales? You're expecting 500,000 naira, but it's now coming back, a good of 50,000 naira is returning back to you. What do? The record is there. You use your return inward and do what? And reduce your sales to get to actual sales. And if you are going to take the class of that, that means that we do it and what we call, we are preparing trading accounts. In trading accounts, you have your opening stock, you have your purchases, and maybe a carriage. You understand? You add it together, and then less what we call carriage outwards. Carriage outwards less to get your cost of goods sold. And when you have cost of that goods sold, you do what? You now remove your closing stock. You understand? To get goods available. Now when you remove that stock available from your sales, you have your what? Gross profit. Am I right? And that gross profit is what you now move to the P&L account. But before you move to that P&L account, somebody now returns some goods to you. That sale you were expecting here on your credit side will be deflected so they can have the actual sales. Is that okay? Please, if you miss, I will come to my class. Now, That is on the revenue recognitions. You recognize that revenue. And also in the recognizing of this revenue, it will only give you an idea which of this revenue should be for tithe and offering on our own. Which one should be for this other thing? So that you can put a demarcation line between your tithe and offering and what other income. Number 2, historical costs. Historical costs. Cost is COST. Now this has to do with all the assets. That means that all assets should be reported at the actual cost of acquisition and not at the current market price. Look up here. I have seen this in our search. That's why I said that. See, we are going to deal with that one. Now, there's what we call original costs of acquisition. There's what we call the current market price. Look up here. By the time we bought this mic, we bought it at what rate? As 250,000 naira. But today, because of the high exchange rates, you cannot buy these 250 if you have to buy it. You understand? Now, the cost you bought this originally is history. But the present price, because of the exchange rate, is what we call current market value. And in your own book, you are not going to recognize the cost of today. You are recognizing the cost of then in your book. And that's why when you are doing your depreciation, you came to the point that your the value of asset has been depleted. You understand? Some people say the only thing you have here is that leave 1,000 salvage value, and which is wrong. That original cost must still be carried along, though the asset has been depleted to zero level, leaving the salvage value. So we are told that when you are working as a foundational information or principle, you don't move the price until the only point you can remove that asset from your record, that original cost, when the asset is disposed. You understand? When you say they are scrapped, you cannot pull it out from your record. But as long as that has not been done, the original cost still remains in the book of your accounts. Is that okay? Now, all assets should be reported at the actual cost of acquisition and not at the current market value. Now, the depreciation, what's the depreciation provided? We have the rates ranking of depreciation. Building has its own rating. Other assets has their own rating. The only asset that cannot be depreciated is what? Land. Why are we not depreciating land? Yes.
It appreciates.
Eh?
It appreciates.
Thank you. The other assets loses value as time goes back. While land, instead of losing the value, do what? Increase the value. So when I depreciate functional fittings, AC, and then the building, vehicle, generator, what again? Which one is stationary? Okay, plants and machinery. And then all those things, because they lose its value as you use them, the wear and tear. And that's depreciation. Depreciation is what? Wear and tear of an asset. And then we monetize it by looking at the rate of depreciation. Sometimes this asset may not even be depreciated, but it's become obsolete. Obsolete means to say that we are no longer used again because of the current or new technology. You understand? We are not using them again. Like if you go to our offices, we have all this table phone, but we are not using them again. It does not mean that they appreciated, but because the advance in technology has arrived, that's why we suspended it. And now we suspended it here. They are still in our own book. What do we do to remove them in our book? That is when the vetting committee comes in to decide whether those assets should be disposed. As I said yesterday, that no asset is moved out, disposed without these committee people being aware. So every asset must be depreciated apart from land. And when we are depreciating assets, listen to me. We have what we call accumulated depreciation. We have what we call current year depreciation. And which of this depreciation is reflected in our P&L? Yes. Then we'll go and use that for this record this one. Yes. Accumulated depreciation and then the current year depreciation. Which of these depreciation is reflected in a profit and loss account or income statement? Why? Yes, can somebody else explain to us why we should accept that as part of our expenses? Yes.
We should accept as part of expenses because the current depreciation deals with the asset depreciation come at that current year. So when we are preparing the profit and loss account, we brought it in to minus it from the profit so that we can get our net profit in that year, that particular year.
Okay. Now, what really happened is this: depreciation is not actual cost or expenses. Are you with me? We have not expenses or expense depreciation. What they actually means in the other normal company operation is that depreciation is that you have idea that tomorrow I will buy another machine if this one is bad. But what do I do now? Let me start saving money little by little. So tomorrow I can add money and buy a new one. So that depreciation is that you are taking the money and put it in reserves. You take money next year and put it in reserves. Take money in the end and put it in reserve. By the time that this asset has gone to scrapped, you now dispose it, and the money you have been saving here, you now pull it out and add money to buy a new asset. Is that okay? That's the extent of depreciation. It is not actual expenses. But that means that money you move out from depreciation is not actually going out of the system. It's in somewhere and where at reserved. But
the reserve is the accumulated form.
Now, accumulated, we have it's not accumulated, but in the normal structure where they have reserve account goes to reserve. Is that okay? Is that okay? Beautiful. Now, when that is done, but how do we calculate our depreciation? How do we calculate our depreciation? Now, when you look at the year, the lifespans of the assets, you divide the lifespan of the asset, you divide the asset by the number of years. Are you with me? Now, for example, we buy an asset for 5 million naira. And we look at that, this asset the last 5 years. Then, how do you know how much I'm going to take into P&L account every month? You divide the value of that asset by the number of years. So whatever thing you do here, and then do what? Remove it and keep. In the other way around, if that asset is disposed, that's the scrap value. What you do is that you subtract scrap value from the cost and then divide it by the number of years to know what is remaining now. And that is exactly what you will lift up to what we call what? The profit and loss account. And that takes us to what we call these assets, what do you call this? Asset register. That thing you did here, that the consultant give you the templates. That is called asset register. And during the consolidation, we have a lot of issues from some of our accounts. Because some of you compress it and fix it, but after they don't calculate it. Some of you don't even calculate depreciation. When we are talking about this depreciation, some of us were not there. But a calculator was given to you. All that you need to do is that fix your asset there, fix well, even the rate was there. All that you need to don't fix the amount, then the thing will run down and give you what should be the depreciation, what should be your net book value. Some of us did not do it. And I want to tell you in this class that is very, very important. You must do it by yourself. Now, how do we keep that asset register? Number one, you must have the schedule. And in the schedule, you have the list of the assets. List of the assets. Now, the next one will be the asset brought as at the face of that year. That's opening balance, which is in your trial balance. For example, the asset for this year, 2022, should be the closing asset in your trial balance 2021 that will begin the new year asset. Am I communicating? That's what you have been doing. Now, when you have the list of the asset, then you have the balance, and that balance will be what? Balance as a face of that year. As a face of January 2022, you have a list amount here for each of those assets. That amount here is what you have as at your last year trial balance on the asset. Now, when you have that now, you have another column. That another column is additional what? Additional asset that you buy for the year. When you add the thing together, you have accumulated what? Cost on the total cost of the asset, which is the cost brought forward, then plus the one of the year. Are you with me? And then the next one will be that the depreciation rate. What is the depreciation rate for each of these assets? You now calculate the depreciation rate of each asset, which is what we call the depreciable value. Once you have that value, you now depreciate it. When you depreciate it, you move that depreciation for the year to what the current year depreciation, while you have accumulated. Accumulated means that if this asset was to be 5 years, and this almost 5 years since you bought the asset, that means that all the depreciation you have been taking all the year must be accumulated, piled up. That's what we mean by accumulation, accumulated depreciation. Now you add the accumulated depreciation and the depreciation for the year, and then and remove it from the available asset. Then you have your what we call net book value. Is that okay? The way you even look at me. But this is what you have been doing. There's no magic about it. But I'm telling you this so you can do it on your own. So we are talking about what? The assets, regular recognitions. We're talking about the historical cost. And then the next one will be matching principles. In matching principle, income during accounting year is matched with expenses of that year. Look up here. Matching concept. Do you know what I mean by matching? Brother and sister, who gave this woman to this man? I do. And at that time of I do, what happened? You match brother so and so and sister so and so. Is that the word? Is it true? who gave this woman to this man? The father come and say, I do. At that time, the sister started, look at me here, my friend. The sister standing here before the congregation or the audience. There is no other sister that can match with that brother. Is that sister standing there, you know what? You match with that brother. Is it true? Now in accounting, what we call matching concept. Matching concept is that the revenue is brother. Then expenses is what? The sister. Who gave this brother to this sister? Who gave this income with these expenses? He said, I do in my office. You bring them together. Bigger. I'm coming now. Now, when you match the thing, that means that all the money you received within the year of accounting, you marry it with all the expenses you made within that year of expenses. And that's when accrual comes in. Because the limits of expenses you make, you understand, that will not be exhausted as at that year. Example is rent. Example is what? Rent. Now, rent means that you pay rent for a year. For example, if you pay rent in June, that rent will be calculated when? In June of next year. And that the actual expenses for that year is what? Is 6 months. For that year. The remaining 6 months is taking over to next year. What do we call that? Prepayment. Thank you. So you are matching. You cannot take all the rent for the 2 years into one accounting year. Are we together? Are we together? I'll use an example now. Example is that rent, for example, you paid the rent for a year, but you studied the beginning of the year. Let's assume that it's 240,000 naira that you paid, but actually paid in June. That June should cover 1 year. Now, in matching concept of accounting principle is that you should do what? You consider the amount that is due for that year and not all that you are paid. Are you with me? So there should be a demarcation. How much out of this 220 or 240,000 naira that is due for this year, paying for and that one the carry forward is called what? Prepayment. That means that you pay in advance. Now, that's the margin concept. Another one is, I'm talking about revenue recognitions, I'm talking about historical costs, I'm talking about margin concept principle, I'm talking about now full disclosure. Full disclosure. All relevant information should be disclosed. Now, during the disclosure of info or data, for example, we have been talking about the sources of funds to the church. And you are expected that when you are reporting, of course, with the system now, the software, you have all the accounting heads, am I right? In the system. So when you are receiving money for retreat, you must recognize it, retreat in that system. When you are receiving money for special program, there are special program listed here. Do what? Recognize them here. And any money, before in those days we used to talk about miscellaneous and sundry. But these days, in accounting, people don't look at sundry again. No miscellaneous again. Do you know why? Because people use those accounting heads to commit a lot of crimes. If audit comes to you and see that, what do you call it, miscellaneous or sundry expenses. These expenses that people make, they don't want to disclose. They push it to general expenses, they push it to miscellaneous, they push it to sundry. And that is the focal point to audit. When they come and see that kind of account, very sweet to do it. Because you must analyze what constitutes and make up that particular account. So what you need to do is is that you should avoid that general expenses. There's something like general expenses. There's something like sundry expenses. There's something like discretionary expenses. That which each expenses have a name called the name and send it to their respective accounting heads. So what we are saying here is that when you are preparing your accounts, you should be able to disclose all the source of your inflow and disclose all the outflow of your expenses. You understand? In the account. In fact, the way we even design the software now is that there's no place to hide. I don't know whether you still have the sliders there, but even when it's there, very rare. Go through any account, you won't see anything here. But if peradventure you push any information, you should be able to explain what makes that miscellaneous expenses, what makes that sundry expenses, or what makes that general expenses. Because each expenses you may do what have name, they send them to their what respective accounting heads. So the next one is what we call entity. Entity concept. What's the entity concept? Yes. You are different from your business. Thank you. That is why that was why I said that you cannot open accounts in your own region and give to somebody and say the church is a church account. You should answer, every account should answer their father's name. Am I right? And when we talk about entity concepts, entity concept means that every organization is a different person from the owner or the person who originated that business. For example, now, Deeper Christian Ministry is different from Pastor Kumi. That's why if you give Pastor Kumi a check on his name, he cannot go through accounts. If you want to pay to the church, you have to write at the back, pay this to Deeper Christian Ministry. So you cannot say because I'm the owner of the church, then account is my own. No. It's a separate entity. As far as a corporation, a company is incorporated and registered, it's different from the owner of that business. So church is different from the owner, the person in charge. It's just a hand to operate the entity, but it's not that entity. You understand? You understand? So when it's in your region, when you sit down there and open one account and give a name, and you are operating it, you are operating an illegal business. So we should take that to heart. Now, before we move on, expenses recognition. Now, if we are not talking about revenue recognition, we should equal to what? Recognize expenses also. At what point do we recognize expenses, my friend? Stand up, my friend, and talk to us. At what point do we recognize expenses? Yes. Precious.
And expenses, when we made our expenses, we record should get, then we look into the report and what we spend in the report.
At what point, David, do we recognize expenses? Because you must understand this. John, at what point do we recognize expenses?
Immediately when the expenses have to be, when loan is paid out. At that very moment, you recognize that expenses.
Is that true?
Yes.
Is that true?
Yes.
If you say yes, stand up. If you say yes, that's saying yes. If you say yes, stand up. You are him now. Do you get it? What did you say?
The point whereby expenses should be recognized at that point whereby the person is giving out the money.
You just give him cash.
As in, as you're giving out the money or you're giving out whatever thing.
I didn't say you should sit down. You accept what he said. No. You accept what he said. Both of them.
Yes, I accept what he said.
Well, no, I said what he said. I need someone to tell me something. Because by the time I was explaining the revenue recognition, I also took DLBCs when we were discussing. What do you want to say? You are always accepted. You know what I'm going to do. You all carry your paper and leave this class. Don't modify it. Yes, kingdom.
Well, they are all right to understand, but maybe what you are looking for is at the point where the service has been rendered.
Thank you. Say that. That's what I've been saying and emphasized on this. That's what I've been saying. I said once it's here in that book I did. But what we did, I said once the services have been rendered and enjoyed and the product delivered at that point recognized. Once you receive the goods, unless you have credit, they give your credit. And once you have received, for example, now, while you enjoy labor here, is it not so? By the month when the bill comes, whether you pay it or not, you must recognize they are owing them. And that's expenses. And when you are preparing your expenses account, you must do what? You must bring it. This part of this money, they are indebted. So, you must recognize the expenses at the very point the goods, the services have been received and enjoyed. At that time, you are legally held responsible to do what? To pay off what you have enjoyed for. You cannot say no. So these principles are very, very important for us to know. Now, having known that, we are going to look at the categories, accounting category. That's the next one. Accounting category, because that will usher us to what we are now want to look at. And in fact, in our stage,
There's one you said objectivity.
okay, that objectivity means that it must be accurate. That's what it means. The information you imputed must be accurate. Must be correct. Must be correct. It must be verifiable. The objectivity. The information you give out or you imputed you must be objective. You must be accurate. You must be able to verify those informations. Put down your question.
What about the growing concern? The growing concern concepts.
Okay, that one we'll talk about if I have that. Now, we are looking at accounting category because this form are reporting usage. please let's not come over because I'm going to do research on these items. There are 5 major categories of accounting. 5 major. Number 1, right? Assets. 2, liabilities. 3, equity. 4, expenses. And 5, income. Categories. This form the basis.
Please, measure it a bit.
Number 1, assets. Number 2, liability. Number 3, equity. Or you can put it owner's equity. I'll explain it. Number 4, expenses. And number 5, income. Now, if you look at the chart of accounts in the stage, these things I've just mentioned now feature out clearly. What we call income, what we call expenses, what we call assets, what we call liabilities, what we call what? Equity. I'm going to talk on them. They are very, very key for us in accounting here. In fact, in your own reporting statements, you cannot do without having these features. These things were mentioned here. If you look at your trial balance, you will see that all these things are there itemized, and that form your reporting. Let's take them one by one. What is asset? When we say asset, assets are not meant to be sold as organizational assets, but it is what the business has to generate other income. That's assets. Assets are what the business used to generate income. There are 2 types of assets. 1, fixed assets. 2, current assets. Now, when we talk about fixed assets, these are the assets that cannot easily be converted. Cannot easily be converted. The fixed assets. Cannot easily be converted. But you can touch it, you can feel it. You cannot easily convert it. Example of fixed assets: land and building. Motor vehicle, that's what is in your chart of accounts. Motor vehicles, furniture and fittings. This brother, you're not writing anything. Are you with us? Plants and machinery, musical equipment, electronic equipment, library, access roads, etc. These are the fixed assets. You cannot convert them easily. Number 2, current assets. Current assets are the convertible assets. The assets that you can easily change, convert either from money to the asset or from the asset to money. Example debtors, people that owe us. We're expecting to collect money from them. Number 2, the money you have cash in the office and cash at bank. Their current assets. Another that inventory. I stock. ETC. Now the third type of asset is what we call intangible assets. Intangible assets. Apart from the fixed assets, we have current assets. Then we have that one is what we call intangible. Why is it intangible? The idea what you cannot touch it. Example of intangible asset is copyrights, goods wills, patent rights, and so forth. Now, like deeper life now, the way we are going on global crusade, we already have a name. We have a unique name. You understand? That unique name can be monetized. And if you monetize it, that's what we call what? Intangible assets. People that are writing books, that idea is what is intangible. So these are the major aspects of our reporting. Now, let me tell you when this intangible asset comes in. Do you know that everything we are producing as CD or GS messages, we are paying for them? We pay what we call royalties. Are you with me? Royalty is part of what we call intangible assets. Are we good to go? Good. Now, number 2, liabilities. Okay, let me just put it like this in that asset before we go. Asset is what the business owns. Asset is what the business owns. Those things that belong to the business is what we call what? Is what we call what?
Asset.
Beautiful. Then liabilities. What is liabilities? Liabilities is what the business owes to outsiders. It's what you owe to the outsiders. For example, people have supplied you goods. You have enjoyed their services. You've collected their materials for building, and you have not paid them. That money you have not paid them, you are liable to do what? To pay them. It is an obligation that you must do what? You must pay. So liability is an obligation which must be what? Be paid. And liabilities moved money out from the organization. So once you owe people outside, either just like what I said in the building, you have collected drops of cement, you have collected blocks, you have collected roofing material, you have collected those things, and you have not paid them. You are what? You are a creditor to those people, and you must do what? Be sure that you have to pay them off. You can't tell them tomorrow when they come that we cannot pay you. You must pay them. And you must recognize it in your accounts. And these are the people called as suppliers. In your stage, we have provision for you to recognize your suppliers. People you are owing. And even the stage shows that you must show how much you are paying them. What is the balance in their account? Is that okay? Are we together?
Yes, sir.
There are 2 types of foreign liabilities. Two types of current liabilities. Number one, short-term liabilities. Two, long-term liabilities. What makes the difference between the two is what? Is a period, is a timing, and it is also the amount that's involved. A short-term liability is a liability that should be settled within a few years, 1 to 12 months, calendar months. Like the people that receive salary advance, you are expected to do what? To offset it within the year or 1 year. People who just buy stationaries of 5,000, 20,000 naira, you must offset them within the shortest intervals. Are you with me? And all those outstanding creditors you need to settle within a short period is called what? Short-term liabilities. Then the long-term liabilities is a liability that you need to offset from 5 years and above. $5 years and above. And since you are going to offset the 5 years and above, in your stage, how do we treat this transaction? We are going to see it as we venture into computerized accounting system. So the periods to offset the long-term liabilities has a longer duration. Is that okay? Is that okay?
Yes, sir.
Beautiful. Now the next one is owner's equity. What is owner's equity? Who can tell me what is equity? Is that capital? Now, in a normal accounting thing, when you get your asset, you get liabilities. Are you with me? When you subtract your liabilities from your asset, what do you have here? What do you have now? Equity. If you look at your stage now, we have equity. How do we get the equity? Equity is what belongs to the business owner. Are you with me? After he has spent all the liabilities from his asset, whatever that remains is his own, and that's equity. Is that okay? Now, the next one is expenses. And we have been talking about expenses since we came. Is that okay? Is that okay?
Yes, sir.
I'm going to somewhere, and I know we're going to land you. So, this expenses, what business pay or spend on his daily activities. When we talk about expenses, it's what business pays or what we call operational expenses. You spend on them on daily basis. And all those money you spend or you pay out is being classified under what? Under expenses. While the income is based on the sources of funds, as I've explained earlier to you. Is that okay? I'm going to somewhere because we'll soon get to computerized accounting. Now, the next one, after we look at the foundation, we'll look at the accounting categories. The next one we are going to look at will be journals and ledger in accounting. Journal and ledger in accounting. Our software we're operating is based on these. That's why you have general ledger, you have GL, you have journals. You want to look at them before we migrate to the software. If you are not paid for your material, search manual, please do that. Because they bring it, you won't get it. So, journal entry is the basis of all accounts for any business activity. Are you listening to me? We're looking at journals and ledger in accounting. I'm saying that the journal entry is a basis of all accounts for any business entity. It's a basis. That means you cannot do without journals. You cannot do without ledgers. They are key. Even on the software, we have been using journals, general ledger. We have been using ledgers. It said bring out the staff ledger. What is that? Bring out the staff that shows, the ledger that shows that the individual staff and what they owe to the organization. You want to know the tithe offering of a particular listing, print out their ledger or their statements. So they are the basis of accounting in business entity. Now, these, some people are distracting me. These journals is grouped into two. Number one, debits, which is signified as what? DR. And two, credits, which is signified by what? CR. That means that ledger or journal has two words, two sides. He has the left, he has the right. Am I right? Yeah. The left is a debit, the right is what? The credit. Journal entries fit ledger accounts. Ledger accounts normally have an opening balances, and that we'll see in a trial balance. But then we will see that how they fit each other. I should come back. I'm already in here. I didn't go to anywhere.
You are too fast.
You are too fast. I have told you, if you need certificate, go and register, come to IDTC. Even this one I'm giving to you here, supposed to come and learn in IDTC. I'm present too. I cannot volunteer for you. I'm very serious. If you want to get certificates, come to my class in IDTC. No, they're not here. Sisters, you can go to school outside.
Why not inside?
You know, here in this class, I am very, very generous to give it out to you. Sisters and brothers, but I think I need to curtail it and give you small, so that you have interest to come to IBTC to register.
For their sake, help others.
No, not for even you, sir. Now, I'm saying that the ledgers and journals are key to us in this stage. Because if you go to say, you go to customer, you go to vendors, you know what? You come across these two words, credits and debits. And it's a principle that is only in accounting that every credit entry must have a corresponding debit entry. And your account cannot balance in stage if you only have one side of the transaction without having the other side of the account. So that means that whatever thing you have on the credit must equally have on what? On the debit and that balance account. So that tells us what we call double entry system, which definitely what by using. What is this double entry system? Accounting entry is done on double entry bookkeeping system. The entry is done in two sides, debits and credits. Debits and credits. Debits and credits. Debits and credits. In the normal manual accounting, when we are keeping the what we call the analysis book, he said your debit is what bring in, while your credit is what take out. I repeat that. When I'm teaching, that's what I use. I will stand like this. Accounting is in T form. Are you with me? It's in T form. And because in T form, you have the lefts, you have the rights. Now your rights in accounting mean bring in. While your lefts is to bring in, that is debit. While your rights is your credit, that's what give out. That means that all the money that comes in is recorded in the debit side of your account. And all the money goes out is debited on what? On the credit side of the account. That's one leg of the account. And now if you are to prepare the real ledgers, do you understand? Let me take a sample of tithe and offering. When you receive, you debit it in the cash book. Am I right? Now when you pay out, you move out to the bank, you know what to credit it. Now if you want to prepare a ledger for tithe and offering alone, that means that tithe and offering that was on the credit now will now cross over to what? The right side. The one that was in debit rather will now cross over. That means that if you go to cash book, you see tithe and offering on the debit side. But if you come to the ledger of tithe and offering, you see it on the right hand side. That means that every debit entry of tithe and offering in the cash book have a corresponding entry in what? In the tithes account. And that's the principle I run in that stage. Some of us will be wondering, how people come here and come here? Because you don't know have the principle. That's what we're trying to do. So, once you do that, you are good to go. Now, let's look at financial statements. Financial statements. There are basically 3 types of financial statements. 3 types. 1, statement of profit and loss, or what we call income statements. Statements of profit and loss, or what we call income statements. Before, and when we are still calling these accounts, definitely what we call what? Profit and loss accounts. Are you with me? Now, in the business setup, look up, let me give you an explanation now. In the business setup, this account cannot be prepared on standalone without doing what we call trading, profits, and loss accounts. Now, when we talk about trading, because trading brings in money, while income and expenditure to what shows the remnant, the gross profit you make in trading account, bringing down to the profit and loss account, how does the money going to be spent? At the end of that account, the aim and the objectives of preparing profit and loss account is to find out whether the business make profit or make loss. I've said something. The aim of preparing profit and loss account or income statement is to show whether the business does what? Make profit or make loss. That's what we call profit and loss accounts. That's number 1. Number 2, balance sheets. The balance sheet is an entity financial positions. in a particular time. Balance sheet. If you open your search, you discover that you have what you call financial statement. Am I right? And you open that financial statement, what you see is just three things I mentioned now. And the third one is what we call cash flow statement. Now, what is balance sheet? Balance sheet is no other account as the account that shows the financial position of the organization. It shows the asset you have. It shows your what again? It shows their balances. It shows their what? The assets. It shows the liabilities. It shows the equity, and so forth. And later on, we are going to switch over to that to look at the template of that when we'll be going to search operations. So, it is a very important that you know this theoretical aspect of what constitutes or what make up your what you call financial statements. That basically you have your income statements or what you call income and expenditure or statement of profit and loss. And two, you have what you call balance sheet, which shows and constitutes the position, the financial position of that company. It shows their assets, it shows their liabilities, it shows their what again? Equity. That's what remained. So that means that there's a formula we normally use on that asset. That would be the asset is equal to liability plus equity. Can you write that? Assets is equal to liabilities plus equity. Asset is equal to liability plus equity. That's one. Number two, equity is equal to assets minus liabilities. Equity is equal to assets minus liabilities. Now, apart from income statement, apart from balance sheets, the next set of that financial statement is what we call statement of cash flow. What is statement of cash flow? This is a statement that shows how and where cash has been earned. Where do you get money? How is the money coming from? So the statement of cash flow will show how and where cash is being earned. It also shows how that money that's coming in is being utilized within a specific period. How and where cash has been earned and how this money is being utilized. How is it utilized? So, that now takes me to accounting cycle. Go ahead and on this. It now takes me to accounting cycle. Let's look at definitions of the accounting cycles and then look at what we're expected to know. In fact, it's based on this. and steps and processes. Come on, put the next slide. So, that's what we are going to look at now. Accounting cycle. We are going to look at some definitions. We are going to look at some steps, and then the processes. The next slides. Now, under these accounting cycles, we are going to look at introduction, the 9 steps of the accounting cycle, the accounting cycle image, the accounting cycle step 1 to 9, and then the passing entries. Then we knock it down with conclusion. Next. Okay? Now, introduction. Accounting isn't just about working with numbers. It is about following what guidelines to get the job done. It's not just to use calculators and key, but what you need to do, you must follow a laid down what guidelines, and that's where we started yesterday. And I talk about the laid down principle that we must practice. So we look at the guidelines. What are the guidelines? Move on. Let's divide the accounting cycle. Now, there is ebbs and flow to every industry. In accounting, the ebbs and flow is the accounting cycle. The cycle accounting, the term accounting cycle refers to specific steps. Write that down. Accounting cycles has to do number 1 with the specific steps that you have taken to complete the accounting process. Eh? But this is what I've been talking about since yesterday. So it is yes.
What if this manual is being made available so that they can follow up as better.
Yeah, you have come. Thank you. I've been doing that since. Now, what are we saying now? The account cycle has to do with necessary steps you must take to get your work in accounting done. So you need these steps, these specific steps that are involved in completing the accounting process. The cycle is like a cycle itself. It begins at one point, one steps revolving the whole cycles. What does that mean? When you start the accounting, we have done that from the process of what? Knowing the duty and responsibility of those involved, the key players. That is there. Am I right? And then look at the sources of what? The sources of fund. That's another step. Now, after then, you know what do you need in your receipt. You know those things that are involved in collections. And then you know what are the things that are involved in making acceptable standard transaction. That's what I said now. Are you with me? So those are the process. So when we talk about the accounting cycle, we're talking about the process you need to follow to get your accounting work done. The next stage. Now, before starting again at the same point and repeating the same steps, the length of the accounting cycle varies from company to company. It may be monthly, quarterly, semi-annually, or annually, depending on when the financial statements of the companies are published. Regardless of the timing of the accounting cycle, the processes involved remain the same, remain unchanged. Whether your company wants the report to be made monthly, quarterly, that does not change the principle. Are you with me? It doesn't change the principle. If your own is to be done annually, like what is done in our own, that at the end of the year, you are expected to prepare your report, financial report, and then send. So at that point, it depends. Where are you going back? Now, accounting cycle also commonly referred to as accounting process is a series, and we are already talking about that. Accounting involves I was talking about that when I was doing declaration of accounting. Accounting involved what? Involve collection, involve recording, involve summarizing, involve analysis, and then involve what? Reporting. We said that. Move to the next. Now, financial information is presented in reports called what? Financial what? Financial statement, which are now given the statements of that financial statement. But before they can be prepared, accountants need to gather information about business and sanction record and collect them to come up with the values to be presented in this report. The cycle then does not end with the presentations of the financial statement. Rather, several steps are needed to be carried out in order to produce your financial statement. So you must have to, there are several steps that are used. It's what we call what? A cycle you must follow. What is a cycle? A cycle is that you start from one point and come back to the point you started. Are you with me? So that is, yes, move on. Move on. Now, let's look at steps. 9 accounting cycles. We are going to look at them. Accounting cycle is the name given to the collective process of recording and processing the accounting events of a company. The series of steps begin when transaction occurs and ends it with its inclusion in the financial statement. The 9 steps of the accounting cycles are. Now, if you follow up our discourse from the beginning, you discover that this cycle has been going on repeatedly. Am I right? We have been going around this cycle repeatedly since we started this segment, since yesterday. And before I even came here this morning, I talked about all this information here. Number 1, step, collecting and analyzing data from transactions and events. How do you collect data? This is the source document that you are collecting from the source document or source of funds. What are those things you are collecting? Where are they collecting money and getting money to organizations? And then you look at how you analyze that. I explained that also. Am I right? I've explained it. So you look at the analysis of those data you have collected. This is time offering. This is special program, this is a retreat, this is a crusade, and so forth. So you don't want to talk things together. Then number 2 is putting the transactions into what? General journals. And explain journals here today to you today. So you look at that one on one, and then you look at the posting entries to the what? To the general ledger. In our stage, because where I'm going is to take us to stage where we are going to work, which is our major concern as far as now is concerned. That's how to take us through this. Now, you look at journals. Go back, we look at this is the entries to what? GL. Well, GL, am I right? General ledger. That's so when you go to the chart of accounts, or you go to customer, once you open it, you have what you call what? General ledger. And that general ledger, as we're going to look at stage, will help you to take care of several payments and several receipts. So it is here that you are posting, capturing those information. Move on. Now we're talking about collecting, putting this transaction in journals and then moving it to general ledger. Now, in the normal accounting, please, for those of us who read accounting, either in the secondary school, so there's what we call the flow of information in accounting. Am I right? The first is cash book. After cash, we have what? General ledger. After general ledger, we have what? Trial balance. After trial balance, we have what? Now, how is information flow? Look up here. In the cash book, all the income are recorded in where? In your debit side. While the expenses are debited in what? In your credit side. When you go to the next page of that account, general ledger, what happened? There's a cross-posting. That's double entry. That all the items you have on your credit side cross over to your debit side, while all the items you have on your debit side crosses over to your what? Your credit, and that balance that. And as you move it from cash book to general ledger, then try balance. Try balance means that all the items you have on the debit of general ledger move straight to the debit side of the try balance. And all the one you have on credit side move straight to the credit side of try balance. Are you with me? I'm not dancing on. I told you that if you want to get certificate, you come. So what I'm saying that is a principle we move into this stage. That's the principle. That in the cash, what happens? Debit, credit. And debit is what comes in, while credit is what goes out. I want to move to the next stage with the general ledger. This one we just mentioned now. You discover that every items on your credit side crossing over to debit, while all the debit crossing over. That is what we call what? That means the first principle that all the debit entry must have a corresponding credit entry, while the credit entry must have a corresponding debit entry. That qualifies that statement. Now, when you are through with that, what is the next one? Preparing an adjusted try balance. At what point in a stage do we adjust? Now, we're talking about asset revaluation. Somebody will ask me, what is the difference between asset valuation and revaluation? And that's information that Lagos wants from all of us who are seeing dancing till today. We can't say that report to Lagos. Now, when you want to value asset, you already have some asset in your book. And you have some assets that are not featured in your book. And you are expected to bring in those assets that are not featured into your book. You understand? And that means that what you originally have in your book, something must be added. And something must be taken away. That what we mean by what? Adjustment and unadjusted. So you did that, and apart from that, you do what? Adjusting the entry from appropriately and preparing the adjusted try balance, organizing the accounts into financial statements, closing the books, and then preparing post-closing try balance to check your what? To check the account. And then we do where we breaking your bank statement and be comparing with your system balances. Are you with me? When we say balance your system, you're now bringing your bank statement that all the items that are found in your bank statement, which is not in the system, you know what? You bring in. And when you bring in, definitely you are going to produce a different balance. Because your accounting will change based on what comes in and what goes out. And that adjustment will now bring in. And this is also known as what? Bookkeeping cycle. Move on. Next slide. Now look at the cycle now. Look at what we call the cycle, the accounting cycle image. This is where we started. Can you see this? That is collecting and verifying such documents. You collect it. Number 2 is to analyze. Analyzing that information, the data field collected in number 1. And then you analyze them into their respective accounting unit. Then number 2, you now analyze each of those transactions. And after you analyze the transaction, you now move them and post them to the ledger. And then after ledger, what comes up again? Your try balance. Then after try balance, what is this one? You prepare your worksheet. And after the worksheet, you move them to the financial statements, which I've mentioned to you, the income statements, what do you call it? A balance sheet, and then the cash flow is that constitute your financial statement. And then you move up here, what happened, you generalize and then post your entries and close account, while finally you do what? You prepared a post, closing trial balance. And that is actually when we send the information out to Lagos. And which I said, during the process of consolidating the account, a lot of hiding pregnancy popped up. What does that mean? Some of us have feel that you can suppress account, cook account and pass. And I told you, it is only in the school we cook account and pass, but in the real life, you cannot cook account and pass because account will be like a balloon or football that you charge into the ocean to press it into the water. The more you press it, the thing will pop out from armpit. The way the thing fall out under, and the ball will be struggling with it. And that's exactly what some of us did. We tried to suppress. And I discovered that even some of the things you submitted, you didn't even do your depreciation at all. But your account balance. How did you balance? How did you balance? So we must really give attention to what we are doing. Because if you are to work on this system now, you must get this principle. Is it principle that will know which account should be debited, which account should be credited? Which statement do we need to prepare with this information? Yes. Now, identifying and analyzing business transactions. The accounting process starts with identifying and analyzing business transactions and events. This document called source document. What are the source documents? We'll be talking about it. Your cash count is your source document. From the district, your group's cash count is your source documents. In the group, your vouchers are what are your source documents. So these documents called source documents are things like receipts, bank statement, checks, and purchase orders. They are the items that describe what a transaction was for. Not all the transactions and events are entered into the accounting system. Only those that pertain to the business entity are included in the process. The purpose of this is to look at them over and over and then decide what effect they have on the company accounts. Now, that's what we started. We started yesterday. Now, what you need to know is that source documents are very key and important. And if you don't keep the record, you'll not be able to track your source documents. And when the source documents are not tracked yet, they are not gotten, they show how you have prepared account. You'll be running here and there to get information which you cannot get. Some of us have an issue with getting information together to form information report. But because the information is not there, you can't gather them. So all the documents that you use, either receiving or giving out, must be accurately and must be kept properly, so that at whatever point in time you need it, you can do what you can pull them out. Especially, you don't play with your cash count. There was a time that I was queried in this organization. Why? When our sale was up, the others, before the building was refurbished, and unfortunately there was leakage there, and all the cash count was soaked. So you all feel I was doing good to the organization. And I do what? I flush the hotel and go and pray away. They said, why do you pray away that cash count? And if you go to that side now, there are some of the cash count that have been rotting. I can't pray it away. Because when somebody will tell you, why do you throw it away? Let it be there. And I remember a staff of mine also did something in this organization. What did he do? He paid money and all the vouchers of that day, you know what he did? He just wrapped them and put on empty waste basket. So when he comes the next day, he will come and pull them out and post them. But unfortunately, the cleaner came forth before him. And when the cleaner came and he was sweeping, he didn't know that this was a very, very important document. And he just sweep and carry everything and put their gun upon the whole vouchers. And the whole localization was set almost on fire. Why? Somebody will say you have stolen the money, that's why you want what? The document. Like what happened by, he said at Abuja, the fire entered the office of the Accountant General of Federation. And then everything there, but you cannot trace it. Everything is gone. So that's why that documentation is very, very key. And there are so many of us that are careless. And you get to the extent that the teller you paid money, you can't trace it. You are careless to the extent that the vouchers, you cannot trace it. You are careless to the extent that the cash count, you receive money from the group, you cannot trace it. You know what they will call you? You know what the name they call you? You already written your name on daily books of trouble. So your source document is very, very important, it's key. So you must stick there. And apart from that, a loan made by the owner in his name that does not have anything to do with the entity is not accounted for what? For business. What example do I use here to illustrate this? Now, there are documents that you should not recognize in the business. Is it true? Is it true? There are documents that you shouldn't recognize in the business. Is it true? Is it true? Answer me now. Eh? Yes or no? If you say yes, raise up your hand. Now tell me, what are those things you should not recognize? Yes. Faith. No.
Okay, document that does not have anything to do with ethics.
Example. Dr. Watts. You have said something now, you don't have boldness to say it. Say it. Now, in a normal business, it's what we call drawings. You prepare, what is drawings? Now, should that sort a document come to be treated in business?
No, it's not your business.
Now, when you come to, there's a difference between the financial statement and the tax financial statement. Now, there are some of the money we spend on our own personal needs or private needs, then we now bring it to business to pay. They will puncture it out. For example, overseer want to take his personal care and then come take money there, go and take it, put in the account without going through the normal process. Is that a valid transaction? No. So, the transaction identifies are then analyzed. Who is the person pointing fingers here? The transaction identifiers are then analyzed to determine the accounts affected and the accounts to be recorded. We'll see that as we move on. The first step includes the preparation of business documents, a source or source documents. The business documents serve as the basis recording transaction. And I've talked about this repeatedly, so I don't need to repeat myself. From the beginning, what you need to do, the sources you need to. Now, recording in journals. A journal is a book, paper, or electronic, which transactions are recorded. Business transactions are recorded using the double entry bookkeeping system. They are recorded in journals entries containing at least two accounts, one debits and the other one credit bills. Move on. the recording process, special journals are often used for transactions that are reoccurred frequently, such as sales, purchase, cash, receipts, and cash disbursements. A general journal is used to record those that cannot be entered in a special book. Now, what does that mean? That in recording these journals, there are things that occur and reoccurring, which we are doing. Example, it says, but here, what is our sales? That is not free. Now we have to do with purchases. What are we buying? We buy stationaries, we buy fixed assets, we buy consumables. What? Financial, it's a purchase. Is that purchase? So we buy those things. Not only that, there are cash receipts, your cash counts, your cash receipts, and so forth. There are what we call cash disbursement. That is when charity comes in, financial assistance comes in, and then assistance to other places, or maybe I go and give me transport, that transport and traveling. As you came here, I don't know whether your God approved the money you came with, or just because you are now the king in your palace. You just carry your money as much as you want to spend. I don't know, I'm just talking, but you know yourself. The money you came with here, nobody gave it to you, but because you are a king, you have a knife, you have a yams, you cut it anyway, what you cut, and when you, as you are going back there, you branch a market, one market here, and then get some things and say, my wife, I go back, I went for training, see, I did share on the training. I don't know, but those things shouldn't come to account of the church. So, what we mean is that those things must be recorded in journals, and transactions are recorded in the what? In chronological order, and as they occur, hence, journals are also known as what? Book of original entries. Now, why do we have to record this in alphabetical order? Because the date you wrote transaction will come first. You understand? Now, from the beginning of the months, when you are paying, so that you can go to that chronological order, what happened? First of the month comes first, till the end of the month. It goes on that order. Is that okay? Then, after then, you get those information. What do you post there? Posting to the ledger. This is what we are going to read in Sage. Posting to the ledger, also known as the books of final entry. A ledger is a coordination of account that shows the changes made to each account as a result of past transactions or their current balances. This is a core of classifying phases. Very, very important at this phase. I want to reclassify which item should go to what do you call it? Other expenses. Which one will go to these other expenses, and then you should be able to spell out which item goes to which account, which item goes to which account. And looking at the chart of accounts, you should be able to know the coding or the code of each of the accounting items that will enable you post the account to their respective accounting heading in the chart. So you must know and analyze them very, very well. Yes. After posting the balances of each account can now be determined. A ledger is a book of an electronic record of all the accounts that the company has. These accounts are broken down by account number and class. That's classification of account. When the information from the journal is transferred to the ledger, it is transferred to each account that was what? That was affected by the transaction. That means that each of the ledger of account that you have will have to accommodate each of the items that ought to be treated in that manner. Yes. Go to the next one. For example, all dollars and treatments to cash will be transferred to what? Into cash accounts in the ledger. Increases and decreases in each in cash will be entered into one ledger account does the ending balance of cash can be determined. What does it mean now? If you now follow the way we normally do our normal DC now, you have your debit, you have credits. When you receive, you record. When you pay out, and you have the balance column. Am I right? So at the end, you don't need somebody to tell you, especially are using the Excel to run this account, you put a column for receipt, a column for payment, a column for balance. So to settle the balance is quite very simple. What comes in increases the money, what goes out will reduce the balances. So at the end of the month, you certainly know balance you have. Now when they begin to say what balance you have, you begin to come bring cash out and count and calculate again and go look for voucher and calculate again to separate and know what you have. I think that's a waste of time. That's a waste of time. Why not capture those things into Excel? If you want to use Excel before you move it here, as money comes in, you just create a column. As you pay out, you create a column. So at each point in time, you know the balance you have. Is it not so? You know the balance you have. Knowing that all money received are bank. So that will totally give you the information comes directly from the ledger. The total debit balance and total credit balance must be equal. Yes. Move on. I think I will give you this material. Move on. Now, a trial balance is prepared to test the equality. In the school, we are told that the trial balance is not account but is an arithmetical accuracy of your posting to show that whether all the debit balances are corresponding with the credit balances. Although sometimes the trial balance will balance, but then the account is not correct. Or sometimes we have some discrepancies in the trial balance. Either error in posting. You wanted to post 5,000 naira, but the second post 500, and that will make the trial balance not the balance. And that's why you need to go back and trace it where the error is coming. It can be error of omission, can be error of commission, can be error of compensation. Then this one here is supposed to be 500 naira. Why this one is 5,000 naira? And then there's another one that you have 4,500 naira. Definitely because you have 500 naira here, and if you add to that 4,500, you will see balance. They compensate each other. So those information need to actually find out the way errors are discovered. Correcting entries are made to rectify them and revise their effects. Take note, however, that the purpose of the trial balance is only to test the equality of the total debits and the total credits, and not to determine the correctness. And that's what I said, the correctness of the account. You will not determine it, though sometimes they may be correct, they may be balanced. So what you need to do is that you should not take it as a sample. You need to make sure that everything in your listing is posted, everything on the debit side is moved to the debit side, and everything on the credit side is moved accurately, so that you can have the correct balances. So then, some expenses, what is it? Adjusting entries. Adjusting entries are entries that are made in the journals and posted to you in the ledger. The purpose of this entry is to bring account balances to the proper account. Not all accounts will have an adjusting entry. If they don't have any discrepancies, you don't need to adjust them. Are you with me? You don't need to adjust them if there is no reason. That's why not all the accounts will be adjusted. But obviously, when you are posting, if you actually were working with us in Sage, you discovered that there was a lot of adjustment we made in order to allow our account to do what? To balance. So that is adjustment. Adjusting entries are prepared as an application of the appropriate basis of accounting. And for example, now I talk about rent. The rent is supposed to be paid for a year, and you start in the middle of the year. So if you start in the middle of the year, then that means that you cannot bring in all the money you pay into one year account. You have to adjust for it, so that the one that belongs to that year enter the year, while the other one is being carried to next year. Brother, that is granted the bill. So, not all. At the end of the accounting period, some expenses may have been incurred, but not yet recorded in the what? In the journals. some income may have been earned but not entered in the books. And that is what I've said that when we are posting this stage, you discover that we bring in our bank statement. And a bank statement, I told you that there are ways that money comes to us. Sometimes they be through direct transfer. You pay one direct to the bank. It doesn't come to your office. You don't have any idea of that transfer. So what do? When you are doing your reconciliation or when you are trying to adjust your system, you bring the statement side by side with what you have in the system. And anything that is in the bank statement and is not in your system, what do? You bring in, that's adjustment. You adjusted your balance immediately. But sometimes you are posting something in your listing. When they are trying to verify the bank statement, it's not here. Where is it present? I think they came out. Have that issue. Now, when you discover, look at the bank statement, you see something in your stage, but you cannot find it. You say this money was paid to the bank. You say now, you show that in your own book, the hard copy, you say that this money was paid to the bank, but you trace the bank statement, you do not see they dropped. It happens. And at that point, what do you need to do? You need to deflect it, remove it because you cannot trace it. Remove it from your system. And then the one you see in the bank statement that is not here, then you bring it. And sometimes the bank will not send you the alert for the bank charges. And those things will call for adjustments. While you are preparing your statements in the stage now, what do you need to do with them? You need to bring all the bank charges into the system to have your accurate balances. And at the end of the day, like what we said now, when all those things have been adjusted, you just see your balance straight and with no stress. But when they are not correct, you are going to have stress, sleepless night until the problem is solved. So these adjusted entries are prepared to have the accounts updated before they are summarized into the financial statement. Adjusted entries are made for accrual of income, accrual of expenses, deferrals, income methods or liability method, repayment asset method, and of expense method, depreciation and what allowances. And all those things are what we now have explained them to us now. You know, we now look at them. What are the income you have? Is it exactly what you have in the system? If you don't do what adjusts. There's no crime, provided you have the evidence of the adjustment. Please let me say this. You cannot adjust a figure that you are not confirmed. Have I made myself clear? You cannot adjust a figure you cannot have evidence. You only adjust a figure that you can trace the evidence of such document, of such a transaction. But if you don't see it, you don't take it because a day will come where the people will come to audit and they say, every document, you begin to do like this, scratch your head. I don't know where I think, you don't know where you do. Why do you pay into the system? So you better verify them before you do what? You make your adjustment. That can affect your income. It can also affect your expenses. For example, you see that in bank statement, there's a payment here, but you can't trace the document that brings in the payment. What do you do? Do you understand my explanation? Yes. It happens. Sometimes carelessness and you not pay because there was no voucher. I see there was no voucher for you to record that and file it. By the time you go to all your documentation in the office, you can't find it, but then it's here in the bank statement. What do? Good enough, if you must throw a check, you should be able to get back to your check stop and check what was the transaction made. Is that okay?
Yes.
So adjusted trial balance. Remember, the trial balance is a list of all accounts and their balances after adjustments have been made. This trial balance is prepared to check and make sure that the debit and credit side is equal after adjusting entries are made. It is used to prepare financial statement. Now, if you follow the flow, now the cash book, the general ledger, the trial balance, then the bottom is what? Is the financial statement. Cash book, general ledger, trial balance, and then what? Financial statement. And the financial statement is in 3 segments. I said that. Number 1 is an income statement. 2 is what? Is what? Balance sheet. And 3 is what? The cash flow statement. That's what the trial balance. That's why if you see in stage, they say, do what? Give us your trial balance. Once you produce your trial balance, this information are already there to draw out the financial statement. That's the essence of sage. And you can see where you're coming from before you now come to the written report. You have captured this information in several accounts. Cash book is there, bank card is there, ledger is there, journals are there, and all those things. Automatically, the system will program it and send this one to credit, send this one to debit, and eventually draw your trial balance. You are not the one that prepared trial balance in the computerized system. You are not the one that prepared it. But naturally, when we are doing this in the school, we prepare the cash book, we prepare the general ledger, we prepare trial balance with ourselves, and then we prepare balance sheet. And what I even did was that I used Excel to prepare this account. That when you enter item one of this one of the sheet, you will just pray to other PC. That automatically it will generate financial statement without my inputting anything there. So what happens here is that once you key in those things accurately and appropriately, don't worry about the trial balance and the financial statement, you will draw it out by itself. Yes. Now the financial statement, when the accounts are ready, up to date, the quality between the debit and credit have been tested and proved, then the financial statement can now be prepared. The financial statement are the end products of an accounting system. A complete set of financial statements is made up of what? Number 1, statement of comprehensive income, that's income statements, and or what we call now. In fact, this currently using the International Financial Standard (IFR) standard. This is what is obtained now. This is what is used now. What is it? Comprehensive income statement replaces profit and loss. You understand? This is what you now have. What is it? Statement of comprehensive income or income statement now replaces what we are using as what? Profit and loss account. So that's number 1. Then number 2 is what? Statement of changes in equity, or what we call this one is what? The statement of financial position or balance sheet. And then this one here, statement of what? Of change in equity is the same thing as what? Statement of cash flow. Are you with me? The statement of cash flow. While this one now, the statement of financial position is what we use as what? Balance sheet. Then what we call it now? The other one is what we call notes to the account, because you see that when you come to the account, there are so many branches. You need to do what? You need to batch them together. For example, you can say income. You understand? In your final account, when they say it's income, but what constitutes your income, that will take you to the notes that explain details and what make up that income. Now, when you go there, down to the income, you see that in the note, what makes this income is that an offering you receive from retreat, crusade, vows and pledges, and so on. That note will itemize what make up the bulk figure we call what? Income. That is what we call what? Notes to the account. Move on. Now, the closing entries. Temporary and nominal accounts. What is nominal account? There are types of accounts. Mention type of accounts. Mention them. Thank you. Mention type of account. Types, mention them. You can't remember. you are disturbing the class. You have to be careful. Matthew, I know that you are not an accounting person. What are the types of account you have? Brother David, mention type of account you have. Deborah, pass. Which one is Deborah? Now Deborah, my Lord and Deborah. Eh? My Lord and Deborah. Which Deborah? Which one is Deborah account? You know some people, you see that they say we learned many years ago. None of them even be in the offices. So you should not be proud that you have something when you don't know what you're doing. Sit down there. We've talked about the real accounts. We haven't talked about personal accounts. We have talked about nominal accounts. And these accounts are very, very key in our detailing and explaining what we're doing. So we must know them. We must know the real account, the personal accounts. Then we know the nominal account. What is real account? The real account has to do with what? Assets, the accounts of assets, and so on. Intangible or intangible assets. Then the personal account has to do with individual, the corporations, and so forth. Then the other one, nominal account, has to do with what? Income, expenditure. That makes up these accounts I talked about. So we should look at temporal and nominal account and income statement. Okay, that's what you say temporal. You see, expo. Even in the church. Shit. Some people are shy. No, but that is three. Real, personal, and now the temporal or nominal accounts, income statement accounts are close to prepare the system for the next accounting period. Temporal account includes income, expenses, and withdrawals account. These items are measured periodically. The accounts are closed to a summary account, often called income summary, and then close further to the appropriate capital accounts. Take note that closing entries are made only for temporary accounts. Real or permanent accounts, example balance sheet accounts, are not what? Are not closed. What does that mean? You can close your income account. You can close your personal account. But when it comes to what? The real account, there is no closing there. That's why the balance keeps flowing. Yes. Posting, closing, trial balance. In the accounting cycle, the last step is to prepare post-closing trial balance. It is prepared to test the equality of debit and credit after closing entries are made. Since temporary accounts are already closed at their respective points, then the post-closing trial balance contains now which accounts? What is another name for real accounts? Permanent accounts. And what's our message that make up the permanent accounts? Thank you. You have all parts. I'll give you certificate. Yes. So good, so fine. Thank you for listening. Any questions? Any questions? Why is that now? Eh? Which one is on? Okay. Any questions? Yes. Yes. yesterday on how we treat the differences. We have difference from the actual card receipts and the documentation is sent to you. And I did mention yesterday on materialistic principle that you need to consider the magnitudes or the amount that is involved in that transaction before you can draw a conclusion. And I said if the amount is not significant, that's immaterial. You ignore it and take the figure, the correct figure. But if what is involved is material figure, then you need to do what? Call the question the person. You understand? When you call the persons and the person give explanation, they are not the one to decide. You put it to the next, the higher authority. Because oftentimes we have something similar. There are some things I can handle, but if I don't receive that will put me tomorrow, then I put it to another person to get it more. The overseer should decide. Was it 2 weeks ago? One of our pastors came with a cash count. And he told me that the group coordinators have discussed with pastor that about 50 something thousand naira was lost while they were going to bed. He don't bring the cash down for me to receive. I said, I can't receive that. They should write a letter to personality it and refer it to my office. Then when they refer it to my office, I will know what to do. He said, no, my group coordinator discussed with pastor. Pastor about agree. I said, no, I wasn't in the meeting. Even I was really in the meeting. There should be a document that this error was committed and this is what the key people blame. And there should be a letter. Society will write it. Because that's material figure and I cannot accept it. But some of us will just accept because the person said my group has to score with the overseer. No, I don't do that. Because you can't reflect it in your record. So if it's a material figure like that, all that you need to do is that let the person up here, chief financial officer, be aware. If you don't put his signature, they find that document because tomorrow issue will come up. You keep it. But if the issue of 10 naira, 20 naira, even on 10 naira, depending on the amount, you can just ignore it and take the correct something. But if it's big figure, then others will be involved. Okay, the degree of material is, I said yesterday that somebody bring 5,000 naira. And when he was bringing the 5,000 naira, 20 naira was missing. What is the difference of 20 naira to 5,000 naira? You see material. But if what means is 1,000 or 500 from 500 to 1,000, 1,005, that's a material figure. The materialities it depends on amount that's involved. You understand? It depends on the amount that's involved. If somebody is to pay 100 million and then 10,000 naira loss, is that material? It's not material. But what is material to you? Listen to me. What is material to you may not be material to you. You understand? What is material to me? Because organization givers share is dealing with multi-millions, and then 10,000 naira is 100,000 naira. Don't break the head for that. But you that is offering at the end of the month is 2,000. I mean, how much? How much is your money? How much is your money at the end of the month? Yeah. 2 point. Someone is getting 2 point, and then 20,000. I mean, 1,000 naira was on there. Will you kill yourself? And then what about the people that receive 300 naira at the end of the month? If you 10 naira for, they will look for you. Awashi, is it true? Is it true? It's okay. Yes. Now, do you hear what she said? He said what reoccurrence, not once. Then there should be investigation to know the cause of occurrence. No, it's not once, it's not twice. It means that the person, someone may be doing something behind the curtain. Then we need to unveil the person. Yes. No, no reverse. What are you reversing? Now, that money, already you know the problem is the money was brought. How are you sure that the person will bring the money? They are not sure. But even if the person brings the money, that takes us to adjustment. You can leave it off. When the person brings the money, you adjust your book. You understand? That you use your journals to correct this. Yes, any question? Sometimes it's difficult to deal with adult students. Some people are almost getting tired.